Hi everyone, I'm Aditya Khemka from InCred Asset Management, and I manage the InCred Healthcare portfolio and the focused healthcare portfolio at InCred. So I want to talk to you about today how the stocks have done in the past year or so, what has driven the performance, and what is our future outlook for the two products. While in the broader markets like Nifty 50, earning growth has just not come through as per expectations, the healthcare companies, specifically the companies which are not in unbranded generic business, have delivered robust top line and bottom line growth driven by margin expansion. If you look at it, Nifty 50 companies in the first quarter of FY25 delivered 8% earnings growth, and in the second quarter of FY25 delivered 5% earning growth year over year, which basically brings the first half aggregate earning growth between 6.5% to 7% for Nifty 50 as an index. And the PE multiples of Nifty 50 are currently still at 10 to 12% above historical means, whereas the growth in earnings is clearly below the historical average of around 12%, which basically tells you that it is going to be difficult for Nifty 50 to continue to deliver returns which is above cost of capital for investors. On the other hand, healthcare companies, specifically the companies outside the unbranded generic bucket, those companies have delivered more than 20% earning growth in the first half. The companies which are in our portfolio, weighted average earning growth has been around 40% in the first half, and we expect the full year earnings growth to be in the neighborhood of 40% for FY25. Going forward, the outlook for these companies for FY26 and 27 as per our estimates remains north of 25% year over year earning growth. The earning growth that we expect is going to be delivered by EBITDA margin expansion. EBITDA margin expansion in turn is going to be driven by healthy top line growth and reduction in raw material cost. Remember, from FY21 to FY23, raw material costs for the healthcare sector escalated given China was not supplying raw material consistently, and we had to procure many of those raw materials at higher than historical prices. Whereas now that China has unlocked, a lot of these raw material prices have started declining sharply, and that decline in raw material prices will start to reflect in healthier gross and EBITDA margins in the coming 2 years, given that there is generally inventory in the healthcare ecosystem of a year or two. In terms of valuations, we believe the right metric to look at is cash PE, which we also look at in terms of enterprise value to operating cash flow. If I look at the weighted average operating cash flow of our portfolio, it comes to around 25 times FY25 estimated cash flow, 21 times FY26 estimated cash flow, and 17 times FY27 estimated cash flow. On the similar lines, ROCEs, which were 10% for the portfolio in FY24, are more likely to be close to 14% in FY25 and about 16% in FY26 and 18% in FY27. So given that we expect improvement in bottom line growth, improvement in ROCEs, and cash PE multiples, which is EV to OCF multiples, look reasonable, we continue to be very, very optimistic about the future of our portfolio companies. Good day, happy investing.